Amazon and Alphabet are set to report their latest results this week. Let's get more on that from David Dietze, Chief Investment Strategist at Dietze Wealth Management Group. David, it's great to see you. Sometimes I think about Amazon and Apple. You could make a case that these would be stocks just to buy and hold forever without even looking at them now, because they've grown so much. Maybe we can put up a 10 or 20-year chart. But Apple, of course, has had some bumps along the way, particularly lately.
Yeah, so absolutely. I mean, they have been all-time legendary winners, and the question is, where do they go from here? There's kind of in slightly different situations. One, of course, Apple's highly dependent on the iPhone sales. By all accounts, the new version 17 is doing extremely well. But on the other hand, of course, people have choices. They've got the Samsung, they've got the other brands, and of course, at this point, it's all about what are the capabilities of the phone. Apple has lagged a little bit in terms of incorporating AI capabilities into the phone. And of course, that's one thing we're going to be watching. There's also been a knock on the iPhone 17 that's not really that much better than the 16. Nevertheless, people are buying that. And of course, we also need to look at the all-important service aspect, the various apps and so forth from via the App Store that they're selling, which has a higher margin, higher growth prospect. We need to hear from them on that.
Yeah, I'm just looking here at a 5-year comparison between the two stocks. Apple has been a double over 5 years, whereas Amazon has been a laggard. It's up only 43%. I wonder why. Is that partly because of concerns about competition from the Chinese e-commerce players?
Well, that's one aspect. The other aspect, of course, is valuations, where Amazon has always had a nosebleed valuation. For the most part, even people like Warren Buffett said Amazon has been just a fantastic company, but you are paying at certain times price-earnings ratios that were approaching triple-digit levels. So I think that's one reason that there's been a difference in terms of outcome. Apple, for example, when Warren Buffett's Berkshire Hathaway started buying it, it was down in the low teens price-earnings ratios. Now, of course, it's a lot more expensive. So that's one thing to watch. In terms of Amazon, of course, they've got two great businesses. They've got their hyperscaler cloud business that they're marketing very successfully. They're a leader there. They've also got the Amazon store, where, of course, they started with books. Now they sell everything, and now they'll sell everything on the part of third parties as well. That's a lower margin business, but still, AI is stalking all these companies, and of course, they're trying to make strategic investments with AI partners because they need to incorporate that rapidly into all of their businesses. That's not going to come cheap. We heard from Microsoft last week that if you spend too much and can't show the results, there's going to be a nasty sell-off. But we also heard from Meta last week, where if you spend a lot and can show Wall Street the results in terms of profitability, you can fare very well with your stock. And so that's what we're going to be looking for with Amazon.
Amazon, of course, put something like $70 million into that movie about Melania Trump. Will you be going to see that one, David?
You know, it's not on my calendar, but it's all about what my wife wants to see. I'll be quite honest with you.
Okay, yeah, that's a good policy. All right. You have some stock ideas for us. Humana. It's been tough on the health insurers, but you see upside here.
Yeah, so Humana's down about 2/3 from its all-time high. I like Humana because it's in one of the best areas of the healthcare business. It's in healthcare insurance. It's focused on seniors. It's also focused in the Sun Belt area of the United States, which is gaining population. So the problem with Humana is also its forte. Its forte is the so-called Medicare Advantage. In exchange for having a restrictive network of doctors that you go see, you pay less. You have caps on your out-of-pocket costs. You can get dental. You can get vision. You can even get gym memberships. That's very attractive to America's seniors, which is the fastest growing demographic here. And so their business is going leaps and bounds. However, they need to get reimbursed from the government. And unfortunately, the government's coffers are under pressure, and they just announced, instead of the 4 to 5% increase in the reimbursement to the Medicare Advantage players, something that's about zero. Well, you know, who knows what's going to happen? But to me, it sounds a lot like those initial, back in April of last year, those initial ginormous tariffs, which were initial negotiating posture. And then, of course, Trump retreated. And I think we could see that here because at the end of the day, the insurers are going to make money. They're just going to have to reduce the benefits if they don't get the right reimbursement. That won't make seniors happy. Seniors vote. So I think that the downside here with Humana is a lot less than the potential upside if the government relaxed those reimbursement policies.
Campbell's, that stock's been under pressure. And of course, the packaged food companies have had trouble in some cases from generic competition.
Yeah, absolutely. And artificial dyes, and they've been the punching bag for everything unhealthy in America today. However, at this point, you're at about a 10-year low with the stock.
Wow. It's
trading about 11 times earnings. It's going to generate about $8 billion in revenues, but it's only a $6 billion company. You've got a nice 4% plus dividend. I think this is a situation where they've got new leadership in there. They can cut costs. They can stay really focused. Of course, their snack business, I think, is very profitable. You got your kettle chips, you got your Cape Cod chips, all those things that we probably shouldn't like as much as we do. So I think you've got some iconic brands on sale. I think the consumer staples area could well take the baton if, in fact, people continue to kind of shift out of the hyper expensive mega cap techs and start looking for other areas, including areas that pay nice dividends.
And H&R Block, we're all looking forward to tax season. What attracts you to this name right now?
Yeah, so this stock, again, is down about 40% from its high,
Wow.
is paying a 4%, about 3.5% dividend, about 8 times earnings, very, very cheap. The concern has been that, AI is going to make doing your taxes a whiz. Well, I think that is an exaggeration. I also think with the One Big Beautiful Act bill that's been enacted, there's going to be some additional provisions that people are going to want help on. H&R Block is an iconic name. That business is growing. In fact, is projected to grow earnings in the low double-digit percentages for the next 3 to 5 years. It's also a relatively small company that could easily be put into the pocket of one of these large financial institution players. With tax season coming, I think they're going to see a surge in business. They need to stay focused on that. And I think this is a nice way to hang out and collect a nice dividend in an otherwise very pricey market.
David, thank you very much indeed. David Dietze, Chief Investment Strategist at Dietze Wealth Management.